Okay, well, if we take a look at our calendar here, eBay comes out with their earnings on the 16th of July, 2 days before the expiration on the 18th, which is absolutely perfect for our trade. So let's go ahead and we want to trade. Now, what we want to do is we want to sandwich our short call here just a little bit below in the money. So let's go ahead and sell the 25s. And then we'll go over here to our Analyze tab. We're going to analyze this as a duplicate trade. And we have to do these individually because it is not a trade that the Thinkorswim platform automatically recognizes here. Now, here's the scenario. This is what we've got, just bringing up this tab. The stock is currently at about $27.39. We are selling one of the July 25 calls, and we're buying 3 of the August 30 calls. So, in other words, we're playing this bullishly. We're playing this as a bullish opportunity. So if the stock pops up, we have unlimited upside potential on the stock. If the earnings are bad and the stock tanks, well, guess what? We have found a scenario in which we can make a little bit of money on the downside if the earnings do stink. And in fact, if it comes down to around 23 or so, we make about 85 bucks. It's not too bad. We still have unlimited upside potential, and we have a little bit of, just compensation for our time, I guess, to put this trade on, 85 bucks. If the stock doesn't move at all, we risk a maximum of $63 on the trade. Now we can play with these numbers a little bit and see if we can get something a little more favorable. We can actually go out to October and see if that doesn't help our trades a little bit. Now in October, if we go out to October for our long 30 calls, our maximum risk now is only about 30 bucks. The problem is if the stock goes down, we could lose 100, 118, 120, 125. If it goes all the way down to 20 bucks, we lose $140. So it doesn't have as much downside protection. We still have our unlimited upside protection, however, our unlimited upside profit. So we could go October. Let's keep it October. Let's keep it August for now. Let's play around with the July 25 call a little bit. If we go a little bit lower, maybe we sell the 2250 call. Well, the 2250 call, if the stock doesn't move at all, we have a maximum risk of about 85 bucks, but we do have a lot more downside potential. We have $307 if the stock goes down fairly dramatically here. We still have our upside limit, unlimited upside on this as well. So, I mean, it really depends on what you think you want to do here. If you want more upside potential, if you think the earnings are going to be really good, you could bring your calls in a little bit. So now you start the profit right away. And, you got a little bit more downside risk here, but if it really tanks, you're going to make 30, 35 bucks. But if it just goes down a little bit, down to, $26, you're going to lose $142. We can go back up to the 25s. We can go to the 30s. Now, that's not a bad scenario. With the 30-25s, let's see, the stock is currently at 27. We buy 3 of the 30 calls for August. Maximum risk is about 62 bucks. If the stock drops 7-8 bucks, we make 80. And if it goes up like we expect, we have unlimited upside potential. So this is a potentially good trade, the 25-30. I like the 25-30. Let's add another call in there. Let's see if we can get a little better risk-reward scenario if we add an extra August call. Instead of 3-1, we're going 4-1. Now at 4-1, we've got $70 of downside risk here if the stock doesn't move on the earnings at all. But remember, they're coming out in the third week of July, so we're short those July 25 calls, and you know what? If the market doesn't move, if the stock doesn't move, well, we're out of the trade anyway, right? And we'll probably lose not the maximum, but we'll lose probably 50, 60 bucks on the trade. If it tanks and it goes down, we still have a little downside protection here. We've got about $20, $30 that we can actually make on the downside. but we have a lot more upside potential. So this is the one I think I'm going to go for here. This is buying 4 of the August 30 calls, and we're going to sell 1 of the July 25 calls. I like that scenario very, very much. I think for the earnings announcement coming out in July, I think that's a great play. We may get assigned those 25. We may get assigned the eBay 25s. Now, this is one more thing that we can do. Instead of going August on this, we could go October, and we could go August on the one that we sold. But you can see that the scenario is not quite as favorable, is it? Let's go down to 3 of these. And it's still not quite as favorable as using the Julys. So let's go back to the Julys. We're going to use the August. We're going to go up to 4 of those. I think that's a very nice scenario right there. There's very little downside risk at all, and we can actually get unlimited upside potential on it.